Hey everyone, last week the new inflation numbers came out and they were pretty much what I expected, or should I say, they're pretty much what I hoped would come out. I'll share insights on where I see inflation going, as well as how this could affect the Federal Reserve's decision on interest rates at their September meeting. As always, I'll also share some thoughts on what the results mean for commercial real estate investors as well. The good news? The headline inflation rate came in at 8.5%, down from last month when it was 9.1%. That's positive, but it mostly reflects changing oil and gas prices. The average price of gas has fallen from its peak of $5.11 per gallon in May to $4.01 per gallon last week. That's a good sign, but food inflation is still high. It's at 10.9%. The trend I'm more interested in, though, is core inflation. That omits the volatile oil, gas, and food sectors. Core inflation held steady at 5.9% in July, but it's still on the downswing from 6.4% in March. That's also good news. Basically, things aren't getting worse. I do expect inflation to slowly come down over the next several months, but I don't think the improvements are directly tied to the Federal Reserve rate hikes. The reason I think inflation is coming down is because supply chains are finally straightening out. At its root, inflation is when prices rise, obviously. Prices rise when there's more demand than there is supply. Supply and demand are out of alignment. The Fed's trying to force the market back into alignment by reducing demand, and they're doing that by raising borrowing costs. It's basically the only tool they have. It'll take time for the Fed rate increases to have an effect because household and corporate balance sheets are so strong. The total amount of cash in savings and money market accounts is $23 trillion. About $5.8 trillion above where it was at the start of the pandemic. So basically, people have cash on hand, so they don't need to borrow money to buy things. As a result, raising interest rates doesn't have as much impact. Yes, higher rates did slow home buying, but retail sales are still climbing. But another way to bring supply and demand back into balance is to increase supply. And that's starting to happen. Supply chains are finally improving. A key benchmark to watch is how long it takes to ship goods from China. The transit time peaked at 83 days in January this year, but it's now down to 63 days. We're a little over halfway back to the normal level of 48 days. That said, inflation is still quite high, and the Fed will likely raise rates in September. Probably by 50 basis points. Of course, if a weird data point shows up between now and then, the Fed could be more or less aggressive with their rate movements. In addition, the Fed is scheduled to double their quantitative tightening program in September, raising their monthly balance sheet reduction to $95 billion per month. That should put upward pressure on the 10-year Treasury. So that's the not so good news for investors. Inflation will likely remain stubbornly high and interest rates will likely continue to climb. In terms of the effects on the underlying commercial real estate space demand, elevated inflation and rising rates will likely have a minimal impact. Apartment vacancy rates did tick up in the second quarter, but I consider that to be a normalization of the market as it moves out of the COVID stance where eviction moratoriums and other policies distorted the market. Space demand for other property types like retail, industrial, and hotels should remain relatively strong. Office space demand should remain stable, but at a high vacancy rate in the 16% range nationally. So, the direct impact of inflation on commercial real estate fundamentals is pretty limited. The more important aspect will be how rising interest rates affect commercial real estate investor activity through the remainder of this year and into 2023. The market has already begun to recalibrate. Some sellers are reducing prices to meet the market, while some buyers are reducing their leverage to meet their yield hurdles. Overall, the commercial real estate market remains liquid with strong investor activity. Active investors are looking beyond the short-term economic gyrations, and they're keeping their eyes on the horizon.